Thank you for tuning in to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll start here with our chart of the week. Now, some of the larger private market companies have been in the news recently, and that sparked some investor fears over the liquidity profile and the risk in private markets. Now, at Signature FD, we spend a lot of time on diligence when picking partners for private capital investment. And this chart here shows why showing strong discernment here in those asset classes is so important. Each bar is the range of returns for managers over the past 10 years by asset class. Now, starting at the far left, we can see very little difference between public large cap managers. But as we get over there towards the right into alternatives, we see massive dispersion. Bottom performing managers have seen very low, even negative returns in some of these categories, while top performers have delivered excess returns over public markets. Now, we think private markets can be an important growth driver for long-term allocations, but getting the manager right is extremely important. Now, last week we touched briefly on tariffs. The Supreme Court struck down the use of IEEPA in setting tariff policies. Then the Trump administration quickly pivoted to a different section to impose sweeping 10% tariff rates. Now, this chart here shows the pre-ruling tariff rate in gray and a 10% tariff rate in blue for various trading partners. Note that for most partners, the tariff rate would be lower, even much lower in some cases. All else equal, that shift should be stimulative for U.S. consumers and businesses. And we're expecting higher tax refunds this spring owing to last year's tax legislation. Consumers have been pretty dire in regards to their present situation, and that's the orange line here in this clip in this chart here in the middle. But their expectations did pick up a little in the latest update as shown in the bottom clip. Now, CEO confidence also jumped higher on its last update. CEO confidence tends to lead investment spending by about 9 months. Investment was solid in the fourth quarter economic growth report, and higher CEO confidence could help support the continuation of that trend. Now, over the weekend, the US and Israel struck Iran. We touched on that potential last week. Here's a good table that shows how previous global conflicts have influenced the stock market. The median correction has been about 5% over 2 weeks. The market's then taken about 2 weeks to recover from that dip. This shows us that the market's able to quickly adapt to geopolitical risks. We do want to pay attention to oil prices, though. Here's an interesting chart that shows real oil prices in orange and core inflation in blue. Note that even though core inflation strips out energy prices, there's still a relationship here. Higher energy prices tend to funnel through to core prices as well. If oil were to rise meaningfully, that could be tough on consumer psychology. They're already being squeezed on energy prices due to higher electricity costs. In blue here in this chart, we can see that electricity costs are up 6.4% over the last year. Now, another trend we're watching is the AI and hyperscaler trade. This chart here shows the Magnificent Seven stocks back to the end of 2014 in blue. They've gained 25% per year since then. Now, the other 493 stocks have gained 8.5% per year. But year to date, the Magnificent Seven is down almost 7%, while the other stocks are up over 4%. So we've gotten a pretty major rotation thus far here in 2026. Now, another interesting chart here shows major developed markets of Japan and Europe since the launch of ChatGPT. And one would think that the US would have been the dominant market since that launch, but it really hasn't been. In fact, if we strip out only NVIDIA, so just one company, which has maybe been the single biggest beneficiary of the AI build out, the rest of the US has meaningfully underperformed these other developed markets. This trend of international outperformance is beginning to look structural. Prior periods of structural international outperformance have lasted about a decade. Because some of the AI names are trading lower, but other stocks have been trading higher this year, the market is broadly out of gear. So, this chart from Ned Davis measures stocks making highs and stocks making lows. High readings in the indicator suggest a lot of both, which tells us that the market is indecisive. Returns have tended to be weak when the market has been out of gear in the past. And that lines up well with our expectation for a more challenging investing environment this year. As a reminder, midterm election years have tended to find a way to provide a challenge. The average drawdown in a midterm year has been over 19%. And note the wide range of outcomes on the chart shown here. So, wrapping things up, the headlines have been tough recently for private market companies, and we reiterate that it's important to thoroughly diligence your private capital investment partners. Tariffs are lower today, and that should prove stimulative at a time when tax refunds are also picking up. Consumers and businesses are becoming a bit more optimistic about their future conditions. Now, the Iranian conflict is likely to inject volatility, but history suggests that markets adapt relatively quickly. We do need to watch oil prices. Electricity prices have already been on the way up. Higher oil prices could dent the recent improvement in consumer confidence. The shine's been coming off of the AI hyperscaler trade this year, and the trend of U.S. outperformance is beginning to look like it could be structurally under pressure. Because there have been winners and losers year to date, the market's out of gear from a technical perspective. Just a reminder that midterm years have tended to find a way to be a challenge for investors. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.